Welcome to another edition of Inside the Economy. I'm Larry Howes. Going to talk about employment, housing, little stuff going on with inflation and revenue and a few other things. Not a lot going on right now, but it's all pretty much good news. Quick look at the numbers. Clearly what we have is an economy that is moving forward. It's not booming, it is moving forward. I'd call it relentless. Second estimated GDP for the second quarter, 3.3. That's climbing. Some of the numbers I've seen for what third quarter GDP is likely to be will probably be in the threes. The U.S. is moving forward. Canada took a big chunk down. That happens when you irritate your number one customer. Germany is still down. They're likely in recession. Their manufacturing is down. Some problems with their customers, some tariffs and a few other things, and a very expensive social network. China, well, no. U.S. manufacturing is moving along fine. You look at the job market, and there have been some media reports saying that the job market isn't doing well, it's slowing, it's falling apart. Well, no, it's not. It is recovering back where it belongs. New job growth around 1%, 1.25%. That's where it's been historically, maybe a little higher. It is not falling apart, certainly not on the wage and hour side. There is some unemployment in the upper end white collar part because they're getting, well, fired or replaced, and they move around and adjust. Nothing wrong with the employment market. Housing, well, we've talked about this. You know, the red here is homes for sale. That's inventory. That's back up. That's way up. Sales are down. Not really. They're moving sideways. They're adjusting to what the market is right now. A lot of rumors, and we've talked about what's likely to be a lowering of the cost of money here in the middle of September. That's a couple of weeks away. It will probably happen, but there's a lot of anticipation in the marketplace saying, well, things will be different when the rates come down. Well, no, they won't. It's going to be a gesture. It's going to have some fervor here for a little while, but right now everything else has adjusted to the marketplace. The house prices out there, and we're going to hear a lot about housing in the next couple of quarters. That's probably going to be the next big thing. Rumors saying, oh, you lower interest rates and you lower mortgages. Well, mortgages are at 6.5. They lower interest rates. They might go to 6.3, maybe, but they've probably already adjusted. The issue is, it's right here. This is the real cost of housing. After we threw all that money, the $4 trillion or so in for COVID into the system, we paid for the inflation. It's adjusted. The real prices in these houses is way up there. In fact, we're past where they were 2007, 2008. That isn't, at this point, a bubble. That is where an asset is valued, a fixed asset is valued after you go through an inflation cycle. Inflation bumps up the price of real estate. The PCE and all the rest of the inflation numbers came in fine. They're bouncing down there where the Federal Reserve is targeting. Not below the target, bouncing around the target. Inflation isn't creeping back up. There's not a lot of pressure holding inflation up. It's just accommodating down. And barring some weird incident, the economy is adjusting to the point where, well, get inflation bouncing along too. Maybe at some point you'll have the cost of money at about 3.5. Right now we're basically at 4.25 or 4.5. If you accelerate that, if you drop rates as fast as you can to get down to that number, well, that'll do some things good. It helps the cost of, and we've talked about this before, it helps the cost of the interest on the treasuries. That's a line item in the budget. It doesn't help the value of real estate. When interest rates go down, the value of fixed assets goes up. Well, they're already high enough. And going from a 6.5% mortgage to a 5% mortgage might move some of the market along, but might not. I think the issues that are going to pop up is going to be we need to do something about housing, and I hope the administration doesn't adopt this as the next crisis. And I hope there isn't a lot of acceleration on what's going on in the bond market. The stock market, the VIX, the volatility in the stock market is very low. It's historically low. I mean, there's not a lot of excitement in there. We're following earnings. Unfortunately, all the anticipation on lowering rates has done this to the markets. We are 20% overvalued right now. As of today, we're 20% overvalued. It was kind of a down day. I don't know where it is right now, but too much enthusiasm, too much speculation on all the goodness of lowering rates. Well, it's not all good. Okay. We're a little overvalued. It needs to correct back down a little bit, back to where earnings are. It probably will. You have to follow one of the other kind of important line items in the budget, and that's tariff income, $29 billion or whatever it was. Doesn't sound like a lot of money, but it is kind of persistent. It's a very efficient way to generate revenue. You don't have to run through a consumer and then through the tax gate, through the consumer, back in the back door. You can go straight to the provider and hit them with a tariff. And whether the consumer buys or not is neither here nor there. Well, anyway, everybody's going to be interested in what the tariff income is for the foreseeable future until they go away. And don't count on them going away. And finally, especially for those that live out here in the West, specifically, well, Wyoming, Colorado, Utah, Montana, a few others, cattle, livestock states, prices received for livestock have done very well. There's fewer heads out there in the field. Their income is doing very well, continues to grow. The grain guys, Nebraska and the rest of the Midwest, well, their prices aren't so great. They've had some great crops. They do a wonderful job. They're kind of pricing themselves, well, making their success less rewarding. That's a whole different thing. Fundamentally, the food side of the U.S. is doing great. One of the few places on the earth that can say that. Well, anyway, what we have basically is good news. We're going to have interest rates coming down. Yay. Pretty good chance, probably 90% chance that's going to happen here in the middle of September. It's not going to mean much. And it's liable to exacerbate the problems someplace else, housing specifically. Automobile manufacturers are already at 0% if you finance through them. I don't think you can get lower. Okay, well, it's all good news for now. As always, send questions along to info@shjwealthadvisors.com. Happy to deal with them. Thanks for joining me.